Money Mindset Mastery Podcast. I'm your host, Jim Leo, and joining me today, as always, is my co-host, Ryan Janot. Ryan, how are things today?
Wonderful. And I know this is an interesting topic. We decided to, well, I was writing a blog about concerns of last year that are kind of filtering into this year, which essentially I wanted to bring in more experts. So we brought in Denis too to talk a lot of the topics that we have today. And it's really interesting the feedback that I got from clients and some of the information that I know a lot of Canadians are seeing online. And of course, as of the recording of this, there's a lot more going on within our world that we may touch upon a little bit, but everything is moving and everything is within a flow right now, and we're still trying to understand what is truly going on. So, with that being said, would love to introduce also, of course, our our third person to the band of brothers as Denis. Denis, thanks for joining us today.
Well, thanks for having me. It's been a while, so glad to be back.
Yeah, it's been a while, and you're right, Ryan. There's a lot going on, even just within the last 24 hours,
Yeah.
and a lot of people are wondering what's going to happen in 2025, and we're going to go through a list of kind of the common concerns for this year that's upcoming, and in many ways, they're really not different than from other years. Right, like it just feels like some of this is very repetitive in terms of what people's concerns are, but we want to touch on a few really important ones. So let's start off with four, and this is specific to Canadians, right? This is the research that we've done. These are the top 15 questions or concerns that Canadians have facing 2025, and the first one is, well, repaying debt. Right, that's a big one. Ryan, you and I talk a lot about that, specifically with our cash flow planning coaching program that we have. But maybe you can kind of touch a little bit about the importance of managing debt effectively and really the impact of high interest on someone's financial health.
Yeah. Well, one of the biggest things, obviously, as we're coming out of the holiday season, it's the accumulation of credit card debt, right? And how to manage the the credit card and the high interest that our credit card companies are charging us, and making sure that we stay within that high interest because that's where they make their dollar bills. So, and the importance of for us understanding one, the B word, which is budgeting, and what the difference between budgeting is and what understanding your cash flow. And we will repeat this throughout 2025 as we did in 2024 is the importance of educating yourself on cash flow and what is coming in and what is going out. And often we very much discuss what are your expenses. So your income, your expenses, what is committed, and we will know right away what are your committed expenses. What last month did you spend on your mortgage or your rent? What did you spend on generally your telephone bill? But it's those other things, the spendable things that we often get carried away with. So it's the importance of managing and understanding where our financial health is when it comes to those things, and repaying often more the high debt uh, objects more than anything, and where there's sometimes almost like a counterbalance that happens when it comes to reflecting on people are very interested in paying off debt completely and avoiding, I think, saving for their future goals. And there's what ends up happening is people, as Jimmy, you've said many times before, it's kind of like a diet where budgets fail. And the reason why they fail is because you're not getting the right support. Often they're not exciting or fun. And that's why it's important for us to talk more about the repayment of debt through understanding your cash flow first and making sure that you're prioritizing what the difference between high debt is and where that is in retrospect to where you want to achieve a goal. Because if you have a goal in mind, it will help motivate you. The psychology of it is that it will help you motivate yourself to achieve all of these goals at a faster pace than just simply focusing on paying off debt, because that's debt is boring. And well, that's what a lot of banks and institutions hope, is that we won't pay off our debts and we'll continue to pay lots of high interest and mortgages, things like that. So
Yeah, and I think just we'll move on from the debt topic soon. Identifying good debt and bad debt, because there is such a thing. Because I think some people believe that all debt is bad debt, but that's not really the case, right? So the difference between good debt and bad debt, typically good debt is debt that you can actually claim as an expense to offset some of your income, where bad debt is debt that you can't, right? So I know over the years I've had clients come to me and say, "Well, Jim, I have $20,000 sitting in my savings account, earning 1 or 2%. What's the best investment that I can put my money in today to earn a better return?" And then I do the analysis and I see their $20,000 balance on their credit card. And I'm like, the best thing you could do is pay off the credit card, right? Because you're paying 22%. You're just giving that away, right, to the credit card company. But then there's other situations where if you're buying a rental property, if you've done a leverage investment, for example, where you can claim the interest as an expense, that's very different, right? And also sometimes even the rate matters. I know, Ryan, we've done the analysis with clients, and Denis, you've done this as well, where if the cost of the debt is 4 or 5%, but you're earning 7% on your money, if you take your money to pay off that debt, you're actually losing the opportunity to earn that 7% on your money. So you're self-financing in that scenario
mhm.
through. But debt is definitely an important one, specifically now because of the holidays, right? And a lot of spending that happened there. So, Denis, do you have anything else to say to that, or shall we get into inflation and rising costs?
Well, just to add a point, because you said the other 2 points I was going to make about good and bad debt. When you're building equity, obviously that's good debt, whether it's a house, rental property, investments, you're able to write off the interest. I would see that as good debt, the high interest as bad debt. And a lot of time when I do the planning is when people are approaching retirement, a lot of them tend to, and that's part of the planning as well. They don't want debt at all, especially the mortgage. So I always, when I talk to clients, I go, let's have a plan to even pay off the mortgage, which is considered good debt, but it's not something you really want to have in retirement when that income is gone. So it's yeah, it really depends on where you are in your life cycle and how much debt do you have to make it priority to pay off first.
For sure. Inflation. We thought that we were beating it. I know there's still some things that are very inflationary. Olive oil, being Italian, I'm sorry. Like, I mean, that's still, I can't believe we call it the liquid gold now in our house, because 2, 3 years ago, $10 would buy you a bottle of olive oil, and now it's $18 for that same same bottle. But the government or the Bank of Canada looked like it was getting that under control. However, with some of the tariff announcements that we received over the weekend, there is still some hope, cross fingers, that they'll get that resolved and sorted. But if those tariffs do stick and for a period of time, people are going to be paying more money for at least U.S. goods coming into Canada, right? So, Denis, do you want to kind of touch on that one, with inflation being a concern this year, and the impact of inflation?
Yeah, and especially the last few years, I have some clients that are concerned that are we putting enough aside? I want to spend this much in retirement. Is that enough now? Any type of planning, and you guys do this as well, any type of planning you do, you add your expenses and then you add some inflation, say 2%, which is what we used to use, to see how much those expenses will cost you in 10, 15, 20 years. But if we're having to add 5, 6%, even short period, that makes you need to save more for retirement because what you have is not going to get you there. So that's why it's important on inflation, especially if you're planning on, say, you want to go live in the U.S. for a while. You're going to be a snowbird, which a lot of people want to do. Again, you're talking inflation in this environment we're in now with the tariffs and everything else. We're a weak Canadian dollar, so that means you're going to need to even save more unless your pension's in U.S. dollars, which 99% of us, I'm sure, are not. So again, these all these factors work into saving for retirement, and not only there is how much you'll need. So we have to be careful on that when we're doing our planning, because if you're going to keep 2%, and inflation is 3 or 4%, then the plan is not really worth much. You really got to look into it and see where else you could raise your funds, or you actually could potentially cut expenses. So let's hope these issues we're having with tariffs is short term, where it really doesn't make that much of an issue, and Canada can continue. Canada was not in a good position before the tariffs, so this is not helping. So let's hopefully this will solve itself soon. Looks like it may solve itself faster with Mexico, but we'll see where Canada is, because this is a fluid issue. It's changing regularly with conversations people are having with our government and U.S. government. So let's hope this gets resolved soon.
Yeah, I think the powers that be right now are literally meeting at this moment to discuss tariffs and whatever else. So we'll see what the outcome of that conversation is going to be like. Here's another one. High interest rates is definitely a concern for people. Now, I would say short-term rates have come down. Even long-term rates have started to come down as well, with bond yields coming down. What I would say, though, in this situation is take a look at the debt that you took on over the last couple of years, specifically your mortgage debt. So if you renewed or got a mortgage like 2 years ago, take a look at what those rates are and compare them to what the rates are today. Don't just kind of believe that you've got a good rate and you're locked in it for 5 years, because there are a lot of people now, what they're doing is they're going in, they're looking at what those new rates are, they're speaking with a mortgage broker. You can speak with John at TVH Verico Mortgages, or Verico TVH Mortgages, and he can help you with the analysis. But what they're finding in not every case, but in a lot of cases, is even with the penalty of breaking that mortgage 2-3 years in, they're still saving a ton in interest costs because of the new rate that they can get today, right? So that's definitely one thing I would encourage people to do, is if you did take on some mortgage debt within the last 2 or 3 years, just do the analysis, because you might be better off actually refinancing that out now at a much lower rate. And it looks like variable rates are back in again, although depending on what happens with tariffs and inflation, I mean, there's two schools of thoughts. And Denis, I don't know if you've heard this yourself or not, but on one side, I'm hearing economists saying, well, the Bank of Canada is probably going to have to further cut rates more aggressively to kind of get the economy going. Others are saying it's going to create inflation and they're going to have to increase rates again. Like, on what side of that fence are you on?
I think they're going to have to cut. We have a weak Canadian dollar, so hopefully that helps with the tariffs. The weaker the Canadian dollar, the more our products looks better. If you're buying either with the euro or the U.S. dollar, so that's going to look better. On the, I don't think inflation will come up. It really depends on where we get hit when it comes to inflation. Don't forget, it's Canada putting tariffs on U.S. products coming in now. So if we're putting 25% on orange juice, well, the odds are that maybe your orange juice will be 25% higher, or at least close to it. Maybe not short term, but eventually, if it sticks for a while, then it'll be passed on to the consumer. So this is a case where uh, a lot of people say, yeah, we should hit them as hard as we can with our own tariffs, but that means their products are that much more expensive. What's going to happen when they put tariffs on us is we're not probably not going to be able to sell as much. Hopefully that Canadian dollar, like I said, offsets it a little bit. But when we put the tariffs, that makes goods more expensive to us in a lot of cases. So I think they're going to have to be careful on that, and it's going to be a wait and see. The Bank of Canada, Canadian economy, as I mentioned, wasn't strong to begin with. So they're going to keep an eye on the inflation rate. We're not in a position in the U.S. The U.S. their inflation is not going down like it is in Canada. So I believe the Bank of Canada is going to take a look, go month by month, see what the numbers are looking at, and hopefully room at least to have a few more cuts this year. But it's going to be a lot of cases. It's going to be a wait and see.
Yeah, I heard. I also heard the LCBO made the announcement that they're not going to be selling any more American booze while the tariffs are in play. And I said to my wife Carol today, "Good thing we're fans of Italian wine, Irish cream, and Canadian beer, so we're not impacted, but other people are." Right? So, yeah. So let's talk about the next one, Ryan. This is kind of like in your wheelhouse with the cash flow coaching, keeping up with bill payments, right? And first of all, the importance of timely bill payments and trying to not miss any bill payments, and also looking at automating those bill payments as well, right? So maybe you can speak to that a little bit more.
Yeah, when it comes to all of them, of course, whether it's inflation, high interest, or even bill payments, the importance of talking with your advisor more regularly and updating what what does your plan or goals look like when all of these things are impacted. And of course, bill payments are one of the bigger problems when it comes to people is paying those on time. Often there's a guidance schedule, and you can look up what that looks like. But when your bill is due, what does that look like as far as how much you pay off, all of it, some of it, whether you're making those payments or not, and just really the automation that happens when it comes to all of these bill payments is it's making sure and ensuring that you're not missing any of them. You know, I think I said this on our last podcast too. It's about regular review of your bills, making sure that you're looking through your debit and credit, especially those reoccurring bills, um, that you're making sure that you're keeping up on. Obviously, I made the adjustment from doing uh, every 2 years to now doing more quarterly reviews. Again, big learning thing. I was doing it quarterly, and I thought, it won't happen to me, but it happened. Here, here I am saying, hey, there may be a streaming service out there, a subscription that you don't realize is overcharging you. So making sure that you're organized, and that's kind of the regular review that we do with our clients, especially on the cash flow system, is making sure that people are going and updating regularly the importance of understanding, being very aware of kind of the expenses that are coming in and out, or sorry, expenses that are going out. Meanwhile, how are they reflecting the income that is coming in, and whether you're getting, again, yearly increases as far as your salary, and is that keeping up with inflation? And maybe that's a conversation that you have too with your advisor of perhaps a change of career or a side hustle for some people out there, and that regular review and avoiding those late fees. I think that's one of the biggest things that I find with people is the late fees really start adding up. And as you mentioned in the last piece, Jim, was, you know, you're paying not only the high interest fees that are going on, but is that eating away at perhaps something else that you're trying to save for in the future? So I think it's a big thing that a lot of people don't really realize can very quickly snowball out of control if they're not more aware and doing regular reviews, whether it's monthly. I know some clients that we've worked with, Jim, like they went from what, quarterly to monthly to now almost like weekly reviews of just, you know, spending 5 minutes. 5 minutes of a quick weekly review can have a huge effect on the day to day that happens for them and their families.
And Ryan, do we have an app that can help a client track their expenses?
Absolutely, Jim. Winton.
What is it called?
The Winton app. So, yeah, it's an app that we use through the educational piece. Not only the coaching that we offer, but the education. We want to make sure that it's kind of twofold. That we're not just, you know, providing the coaching session, but we're also allowing some sort of education that happens for clients. And this is a big thing, to bring all the data together so they can visually see what it is that they're tracking when it comes to Winton. So.
Yeah, so if you want to find out more about the Winton app, you can go to our website, tvhfinancial.ca, and look through the behavioral cash flow solution section, and you'll be able to find more information there. The next one, this black cloud has been hanging over our head now for probably about 3 months, or sorry, 3 years, not 3 months, I wish. And it seemed to kind of feel like, okay, maybe the skies are clearing, the clouds clearing, the sun's shining. And then we had, again, this tariff announcement over the weekend, and man, that cloud is like hanging over us again. And that's really the possibility of a recession, right? I think that's still a legitimate concern for a lot of Canadians for 2025. What I would say is that the common mistake in kind of dealing with being in a recession is that a lot of people don't have an emergency fund. Now, there's really 2 ways that you can fund an emergency fund, right, Denis? One way is you can accumulate money into a cash account, for an example. Some people use their TFSA as an emergency fund. Mm-hmm. Another way, too, from a planning point of view, is using a line of credit that has no balance on it as your emergency fund. So can you maybe talk about those 2 options?
Yeah, well, obviously the line of credit, it's a combination of what I tell clients, especially when they're still working and not retired yet. A secured line of credit, which connects your home, obviously, and has the lower interest rate. I've seen some unsecured line of credit sometimes that are 3, 4% higher than prime. So it really depends on what bank you're at when it comes to that. So secured line of credit is preferable. A TFSA is great because you can contribute as you would normally, and if no emergency takes place, uh, it's for retirement. The key thing about that emergency, problem with the roof, problem with the house, you need to make sudden repairs, you take the money out tax free, obviously. That's the key about having it. You don't want to be too aggressive because you may need that money, but you want to have to see some growth in it. And like I said, and if it's not used, all the better. It's for retirement. So continue, always assign, and you don't really want to assign that to too much else, because if you assign to somebody else, something else, another goal, it may be emptied out and an emergency may happen. So TFSA, perfect. Line of credit is a good backup as well. Having both is even better.
Yeah. Now, the next one we're going to talk about for, again, concerns for Canadians for the upcoming year. This has been on a bit of a simmer, and I think because of this weekend, it's now at a boiling point, right? Which is job security.
Yeah.
Now, there are a lot of people who are really concerned about if they're going to have a job next week or over the next few months, right? So, one of the common mistakes for a lot of people, and I think most people are kind of struggle with this, is really just not updating your own skills, right? To make yourself sellable to another employer, even into another industry potentially, right? Sometimes we kind of get caught in or caught in our rut, and we're doing our job, focusing on the job, whatever else. But I think if you're able to spend a little bit of time just improving your skill set, in the event that something were to happen where again you did lose your job, you don't want to be dealing with improving your skill set after you've lost your job because you might not have money to get through that situation, right? So if you're able to, and listen, I recognize as a husband, as a father, that yes, we're busy doing a lot of other things as well. But I think if you try to make a bit of an effort into improving your skill set, that puts you in a better position if you do need to change jobs or industries, especially if you do lose your employment because of some things that you just can't control, like tariffs, right? So that's just a point that we're trying to make. Cost of living. So Ryan, this is probably more you as well. So with cost of living, some of the things too is overspending on non-essential items. Like you're really good at identifying what you should be spending money on and maybe what you shouldn't be spending money on. So maybe you can talk about some of the common mistakes and maybe a tip that you can give our listeners.
I, I think a lot of it comes down to, again, our cash flow system and just understanding. I think the thing that I find most important when talking not only with clients, friends, and family is what are your values? What is most important to you? And often that creates a lot of great dialogue with a lot of people. Is what is the most important thing for you and your family as far as like creating joy? And that question often comes up a lot, and uh, often allows people to not quickly go onto Amazon Prime, and whether or not, and the second part of the cash flow piece that is just as important is having a great goal for people to achieve, and for myself or many families, it's whether it's travel or kids' education is hopefully something that's a little bit more short term, right? And the more people keep in mind how things are how things are more achievable in the short term by keeping in mind the things that are maybe costing you money that are non-essential. um, that often helps people thrive when it comes to achieving their goals faster. And again, just looking at day-to-day things that I know lots of clients share with us as far as things that they've seen, whether it's cooking or having a coffee at home, reviewing your daily expenses or yearly expenses to make sure that things aren't getting out of control, Those are the things that I find most effective. That really, our cash flow solutions, for instance, often we're unraveling anywhere between $1,000 to $2,000 worth of money that people are allowing to kind of get away from themselves, and by recouping that money back into their own pocket can help with different strategies, achieving their goals faster, and it's been really eye opening over the last couple of years when we talk about this kind of like adding joy and matching people's values and creating these smaller short term, how quickly people achieve whatever their next smaller term goal is, so they're able to repeat it over and over again while saving for the future at the same time.
Yeah, I mean, I guess for me, what brings me joy is cigars and beer. Um, so I don't know if that's something I should be shooting towards. So right now, you and I will have a conversation offline afterwards.
Yeah.
But going back to saving people that cash flow, like today, an email came through from our partner John at Verico TVH Mortgages because last year you were working on a retirement plan for a client.
Mhm.
You introduced them or referred them to John to work on their situation. And the email today said, we're going to save them or improve their cash flow by $1,500 a month.
Yeah.
Like, can you imagine? $1,500 a month. That's $18,000 a year. That because you stepped in and you spoke with these clients, they had no idea. They were just kind of like burying themselves in the situation. And you stepped in, provided them guidance. They spoke with a professional. He's freeing up $1,500 a month. And with that $1,500 a month, we're not saying give it all to us now. We're going to invest it for your future, right? But we might turn around and say, hey, let's work with $800,000 of that, right? And let's set that aside for your future now. And that extra $500 that we freed up, go enjoy, have fun, right? So I just wanted to share that example today because that's a win,
Yeah.
right? That's a big win, and that's common as well. It's not a one-off situation; it's quite common. So, if you're looking again, I'm going to reach out to our listeners and our viewers. If you're looking for, some of that choking that's happening around your neck right now, the financial choking, and you think there's no help for you, reach out to us, and we will do the analysis, and we will connect you with the right people to see if there's a way that we can kind of release some of that stronghold around your neck and give you a little bit more opportunity to breathe. Right.
Yeah. Yeah.
Alrighty. Day-to-day expenses outstripping our income. So this is basically kind of overspending, right? Common mistakes. Going back to the Winton app, not tracking daily expenses, right? When you're not tracking, you don't know what you're spending, and we tend to overspend if we're not tracking. So here it's saying to meticulously track your spending. We have an app for that. So if you'd like more information on the Winton app, please reach out to Ryan or I, and we can help you with that. Unexpected financial emergencies. Not saving for emergencies. That's a big one. So, Denis, maybe you can speak a little bit to that with how people can address unexpected financial emergencies.
Well, I touched on this a little before when it came to having an emergency account. Is there's going to be a lot of things unexpected, even at home here, where we suddenly had to we had a leak on the roof. Suddenly we had to get somebody in, go to fix it, fix a little of the damage it's done. It just, you know, not planned expense, but it does happen. So this is where you need to have that emergency fund for those unexpected. And most of the unexpected emergency expenses, you have to do it. There really is no choice. Especially for us, for that rainy period, it's either continue to have rain coming in the house or fix the roof. At first, we thought it was something minor, and then okay, no, somebody actually has. We have to call somebody in to do it. So these are the type of things. It could be a car that you thought would last a few more years just suddenly falls apart, and you need to get one. And then you start looking at buying a new car. Or are you going to buy a used car? And you make all those type of decisions based, but they have to be made quickly.
Yeah.
So having a little of that money on the side gives you a little more time to make that decision. But some of these decisions have to be made quickly, and that's why you need to to have that emergency fund to be able to deal with it, and then move on with your regular expenses. So it could be anything. I use the roof as an example, but it really could be anything in the car.
Yeah.
Yeah. Well, it's funny you speak about the car because the next concern that people have facing 2025 is a new vehicle purchase. And I don't know if I'm qualified to speak on this because vehicles, that's my weakness. So I might need one of you two guys to take over because I'm probably going to give bad advice when it comes to vehicles. But really, the common mistake for a lot of people is they buy a vehicle without really considering depreciation. And where this really becomes important, it goes back to one of our earlier talking points about bad debt, good debt, right? There are times where I've had clients in the past uh, call me saying, "Hey, I need to drain my TFSA $50,000 because I'm buying a brand new vehicle because we need a vehicle." I'm like, great. Is there a financing option for that vehicle? Yeah, about 3%. This is a few years back. Okay, so 3%. What's the payment? Can you afford the payment? Yeah, the payment's not a problem, but I don't want to pay interest. Why would I pay interest if I have the money? Well, then I do the analysis of, okay, well, how much again would you have earned on that $50,000 in your portfolio at 5, 6, 7%? This is actually what you're missing out on. This is what you're losing in that scenario. So the first thing is you're going to be paying more out of pocket because of that lost opportunity cost if you pay cash. Secondly, Denis, as a portfolio manager, right? You drop or you roll that $50,000 vehicle off the lot, and you've paid $50,000 out of your pocket cash, right? You're down $15,000, like just like that, right? With a 15% depreciation. So it doesn't make sense. So what I would say to people is, again, reach out to us so we can run those numbers and those analysis for you. Now, you can consider buying a used car over a new car. But again, we reached a bit of a crossing point a few years ago where some used cars were actually more expensive than the new cars,
Mhm.
right? Because of the whole the chip situation, and some of the newer cars were not coming with the same features as some of the older cars were. Like it was a crazy situation a few years ago. And then you have to worry about warranty and repairs and all those things. So let us do the analysis for you. Probably better Ryan than me because again, cars are my weakness, and Denis can help you with that as well.
Sorry, I would just add to the new
Yeah, go ahead.
purchase vehicle, especially for young people too. They just feel like, a lot of my young clients and people that I've worked with in the past, I would just see is the vehicle is like the status. And I would say if you want to put yourself back 10 years easily as far as like your financial wellness, buying a vehicle is probably the number one way to set yourself backwards. Everybody has a reason for it, you know, you know, getting to and from work, things like that. But it's always great to talk with a professional when it comes to like the balancing of buying new, buying used, leasing, financing, like all those things, and being able to truly walk through what that impact is going to be for you, and then for those people, like, going into retirement too. Often, I know some advisors have even advised that this may be one of the final big purchases you make as you go into retirement. That's a great conversation to have because likely that vehicle is hopefully going to last 10 to 15 or if not 20 years. As somebody who just, I guess, 2 years ago bought a car too at the height of used cars being quite expensive, believe me, I was looking for the ones that had the roll me down windows, that were easy and probably had still some sort of cigarette lighter in them. So, but I definitely have these conversations with people about what is the purpose, how is it going to lead into the next conversation about, what happens if you have a loss of income, right? Are you able to afford those things if there's a sudden loss of income? Are you relying on one single source, or is this vehicle potentially helping you in two different avenues to help make sure that you have income in? And again, I will open up to the floor to both Jim and you, Denis, as to the loss in income and strategies to cope with that. I know obviously we lived through the thing that happened a few years back, and that people were losing their jobs, and how that impacts some of the things that we've just talked about, whether it's creating an emergency fund, and making sure that you're ill prepared when it comes to a big emergency or a new vehicle. So
Well, we can kind of roll the whole vehicle and loss of income side of things too, and using cash or financing. Because here's the thing: if you write that check for $50,000 for the vehicle, and 3 months later you lost your job, you can't get any of that money back. You've lost it. It's in the vehicle, right? And then if you're forced to sell the vehicle again, you're down 15% right off the bat. So typically I recommend that people look at financing something as long as they can support the payments and keep the money in their account. And if there's a month or two that they can't make the payments, at least they can draw from somewhere to cover those costs, right? And the other thing too is, if you have the vehicle, then you can become an Uber driver if you lost your job, right? You do Uber Eats, you can do whatever. So it can be used as a way to earn some additional money, and that kind of leads to the whole loss of income concern for a lot of people. And I think this is a common theme here, right? To me, it's have money set aside if that were to happen. So again, don't write a check for $50,000 to buy a vehicle or buy a boat or do whatever. It's about having use and control of your own money, and you give up use and control of your money when you do that. But at the same time, if the car loan is 15%, that's a whole different conversation for us to have as well, right? And diversify your income stream. I think that's another thing is, Ryan, you mentioned side gigs. Or even investments, right, Denis? Like, you can put people in an investment portfolio, depending on how much they have, that could potentially draw some income to help subsidize some of the income that they need, right? So these are tools that are available. I don't know if you guys want to add anything to that before we move on.
Yeah, I just want to add that it really depends why you lost your income. If it's because you hurt yourself and your company doesn't have a disability insurance, you want that put in place. Disability. If you suddenly, and we know, unfortunately, it's far too common, you contract cancer and can't go into work. A critical illness policy would help you get through that period where you can't go into work. So it really depends how you lost your income. And now I know people that lost their income, especially during COVID, because their entire place of employment closed down. That's different. So it's a matter of trying to find that income quickly, especially if you were not prepared for it. But if it's due to illness, hurting yourself, and because I'm seeing more and more that some of these smaller companies, or not all of them, but just some of them in the smaller companies, they just don't have those type of benefits available if somebody were to hurt themselves. And critical illness is still a little. You'll get some banks offering it maybe, but that's not something that critical illness policy that most people have access to unless they buy their own.
No, from the banks, you know what I'm hearing more of now? Accident coverage, right? So it's not even critical illness. It sounds like it's critical illness to make them think that that's what it is, but it's critical accident insurance. And the chances of you claiming on a policy like that are under 2%. So be careful what you're buying and understand what you're buying. And if you want proper advice, speak to us. We are licensed insurance advisors. We are brokers as well. So we don't represent just one single company. So if you're looking for that advice, we are available to people out there. So I think the next 2 points, so number 12 and 13, managing the cost of living and financial planning and budgeting, basically are the same, right? Because one of the common mistakes with managing the cost of living is for people not seeking financial advice. So we talked about the one client today that our partner John was able to help them and free up $1,500 a month. They wouldn't have taken the steps if they hadn't spoken to you, the professional, to kind of say to them, here's a potential option for you. Here's how we can free up some cash flow, right? So don't be afraid to reach out to a financial advisor, a wealth advisor, a financial planner. Again, we offer all the tools in-house as well. So we'd be more than happy to walk you through your situation to see if we can free up some funds. And then financial planning and budgeting. Ryan, we don't really believe in budgeting so much. Again, we use the behavioral cash flow program. But I think this has been the theme in our session today, right? Is track everything, make sure you understand what you're spending, what's coming in, right? And plan for the future, and, speak with a professional is the bottom line. So anything you guys want to add to that before we get on to the next one, which is investment strategies?
Budgeting is short term, right? Create a budget for a short term goal, making sure that you don't overspend on what that goal is. You budget for a vacation, right? Budget what your spending goal is, but the overall is understanding the cash flow that happens through that, and making sure that you're truly talking to somebody that's going to help you, coach you, and make sure that you keep on track to achieve the goals that you want to make, right? It is not talked about enough when it comes to our financial wellness, and understanding that there's the circle of wellness, and that financial is just not part of that. And we want to make sure that people are talking about it more, because that financial wellness, that financial support impacts everything else that makes sure that you get the right health and fitness and psychological and social work, like everything else that comes together, which then leads into, of course, our next ones, making sure that you're finding the right investment strategies that support you, your family, and your business when it comes to achieving their goals, and understanding, especially over the last, as we go through cycles when it comes to the market, understanding what your true risk tolerance is. And Denis, you are the expert when it comes to that, so I'll let you take it from here.
Yeah, and anytime you want to develop a strategy, usually you assign money and you assign it a goal. So the one thing we do look at before we even offer a portfolio is we dig into the goals. What is the time horizon of this goal? If it's retirement, obviously it's a long time horizon. But if it's for buying a vehicle in 4 or 5 years, then that's a little different as well. And then after that, we send them some questions. We want to know what their risk level is something today where they'd be in an absolute panic because there's tariffs. Is that something that would affect them much? A lot of people say no. I'm long term. These ups and downs in the market that's happening, that's fine. So that opens up a little more to the type of portfolio. We could have growth. We could be in the more that balanced category. We could have conservative. With our portfolios and the alternatives, we really, especially on the conservative side, it really helps. We mitigate some of these losses that are happening. Today, there's a couple of things mitigating the losses. We have Canadian dollars getting beat up. We have holdings in the US. So the US dollar is going to show just a return, just the fact that they're in US dollars. Bonds are up today. Again, that's another offsetting factor to the bad equity markets. Adding to that is the alternatives. So you're looking at other, when one section of the overall financial markets are down, you want something offsetting to that. Some people are just growth. They'll take this lump, maybe buy more, and they know longer term the equity markets will outperform, so they're fine with that. So we have portfolios that sort of suits most clients' needs, with the alternatives, with a little of the offsetting. These absolute managers that look for returns no matter what the market is doing. Some people strive in negative markets. They'll buy, they'll sell, do maybe a little short sell, depending on the type of the markets when it's volatile, and that's where they get the return. Other is just long-term investing, and we have a combination of both in our portfolios. And depending how we see the markets, foresee the markets in the next, say, year or two, that's when we'll decide how much we allocate to each. So
yeah, and I think from an investment strategy and diversifying, I think there's really three major common mistakes that people make that really blow up their investment portfolios. The first one is psychology. They make emotional decisions. They react to situations. Like I haven't gotten a call today, but I'm sure there's a lot of people right now looking at the news, freaking out, and maybe knee-jerk reaction, right? So that's one common mistake. The second one is not really investing in the appropriate risk profile. Either some people invest in something that's a lot riskier than they probably should be in. And then there's the opposite, where people just don't want to take any risk and they're investing in GICs in cash and it's not keeping up with inflation as well, right? So those are two. The third one is having too much exposure to a single asset class. Like throughout the years, even when I first started, it was .com, right? It was all the tech stuff back in the late 90s. I've never said no that a person should never put their money into stocks like that, right? My concern is always put some, 5-10%. The problem is when people kind of follow these trends, it's like it's an all or nothing situation. It's almost like they're in Vegas and they're putting it all on red or whatever, right? When marijuana came out and people were putting their money in marijuana stocks, I've never said to anyone, no, you shouldn't put money in marijuana. It was be responsible, 5 or 10%. Don't put a whole bunch of your money into it, right? Bitcoin's the same thing. Gold, I mean, I don't know how many times I've heard from people saying, well, my dad said that I should just put my money into gold because gold never loses money. And then you look at the historical value of gold and you can see it goes up and down just like the stock market does, right? So it's never don't do it. It's be responsible. Make sure that it fits with your overall holdings and your strategy and within your risk profile. Because Bitcoin doubled up over the last 12 months, but I'll tell you, people got wiped out, prior to that when there was a major correction in Bitcoin. So just be more responsible with your investing. Diversify. Right, Denis? Does that make sense?
Yeah, it does. And it's not every account needs to be invested the same way, depending on your goals. So you can mix it up. You can be a little more aggressive because you're not going to use it as sort of your growth aspect where everything else you want to be a little safer. And what I've seen over the years is that nobody ever complains when, even if it's the wrong risk profile, if they're getting positive returns. Nobody ever complains. But when that turns around, and it can turn around quickly, that's when you start hearing, okay, who should not have been in those portfolios to begin with. I know working in asset management, I was working with some brokers, and then one broker had, this was in the late 90s, early 2000, had a good portion of his portfolios for all his clients in these boomer economics. So you know what happened when that crashed hard, and there was some very upset clients because given their risk profile, they should have never been in that. Maybe a little bit their fault because they never complain. Oh, I'm getting 15, 20%. Well, you're getting that for a reason because you did take on the risk. Now, when that reverses, and believe me, the 2000, the market did bounce back like it does these days. It took a while before that to bounce back. So and some people don't have a while. They're starting to withdraw. Once you start withdrawing, that money's no longer there for the bounce back or for the eventual, market gains afterwards. So you got to be careful, especially when you start withdrawing. That's another reason. And I know you've talked about many times the sequence of returns. That's again another reason to be careful on how you're invested because when you're taking money out, it's not going to be there when the eventual recovery comes.
I remember that boomer up in economics. There was one company in particular that was behind it big time, and almost weekly they'd come into the office and there'd be a book and there'd be all these charts and and a lot of advisors were like, yeah, we're going to put all our clients, our their money into 100% boomer economic funds and whatever else. And I just kind of stayed back on, nah, maybe a small percentage, but no way. And they got hurt. Labor sponsored funds was another one, right?
Yeah.
Like I did not put a single dime into a labor sponsored fund. And a lot of people are like, oh, this sounds sexy and exciting. And guess what? Then they get their statements and they're down 60, 70%. They forget about the benefit of the tax credit for investing in a labor sponsored fund because all they're looking at is at the end of the day is what is my money worth in this investment, right? And that was, again, another area that kind of blew up. So, Ryan, I'm sorry. I know you were trying to kind of step in to say something as well.
No, again, the strategy is not only investment, but the insurance strategies, that how everything is layered when it comes to true diversification. Again, please listen to it. Anybody who's never heard a sequence of returns or who is not meeting with their advisor a minimum once a year, if not twice a year, and anytime something major happens, please reach out to us because that's often the common mistake that I find with a lot of clients is they just didn't hear from their advisor. And the door goes both ways, but I know we definitely make an effort on our side to make sure that we're reaching out constantly to our clients, especially if we haven't heard from them. What's changed? The Denny, you've said this many times. Everything is so fluid, and things can happen like that. And when there's a change in your strategy, a change in something as far as like work, something happens to a family member, we're the often the first top five. I always say top five, and many clients always remember that I say, please make sure I'm your top five because the impact that can have as to how we can start making small changes to your strategy and how it is impacting you, your family, your business, and not what your neighbor says or a coworker says, because often people get caught up in that. I've heard some great crazy returns over the last week, and I always said, how were those returns when it wasn't so crazy? And often it's, I lost a lot, right? And they weren't prepared and they didn't have that dialogue with their advisor. The importance of making sure that we're part of those five. And again, I don't, since we started implementing things like sequence of returns and truly diversifying people's portfolios, especially those clients that are going to retirement, I've never had so fewer calls, and those calls that we do get are always great calls about how fortunate they are that that we were able to educate them and walk them through a process that truly added a strategy that didn't cause stress at night. And I think that's one of the biggest things many people don't take in consideration. And as we roll into the next subject, as I love rolling in, as people prepare for things like retirement, and I didn't add this as part of the conversation that we had, but even the legacy leaving when it comes to people. So the retirement and planning, and Denis, you're a great person to talk about this. Is the importance of starting early, maximizing retirement savings, however that may be, based on each individual strategy, not what a strategy that a certain institutions will do, because everybody is kind of put into a cookie cutter, depending on if the cookie cutter is the shape of a gingerbread man or a Christmas tree or whatever it might be. I do have a dinosaur cookie cutter, but that is, I feel like a very failing to really save and understand what retirement looks like. And as I kind of tacked on there more recently, is that legacy planning. And the last 3 months have been a huge eye opener for me, for family members, for close friends, as to what that retirement and legacy planning looks like and where we're truly leaving ourselves and our family members in kind of like disarray, essentially, as we go into it. So, Denis, I'll let you take over as far as how you can help people when it comes to us tackling the first part and you helping kind of bring it all together for people.
Yeah, well, one of the things when I look at retirement planning, if you're in your 40s, you may not have a clear vision of your retirement just yet. The one thing we try to do is we start the plan. Let's get that initial look. And what happens is over the years, people will look and start thinking more about retirement and then maybe tweaking it a little. Okay, I don't want to be there. I actually want to sell my house, basically move somewhere else where it's cheaper, get some money in. Let's put that in the plan and let's start the conversation. Retirement planning and being in retired is actually a mindset because you don't know really that when until you're there of what it's going to be like. I'm not going to get up anymore. 8 hours, my 8 to 10 hours of my day is gone. How am I going to feel that? You want to really get people into the mindset at first, and that's when once they're in the mindset, that's when they're more open to investing and looking at different strategies as well. Okay, this is what I want to do. We'll use my RSP for this, obviously, to pay fixed income and everything else. Maybe a TFSA for those extra expenses. Go down to Florida, maybe become a snowbird, depending on the value of the Canadian dollar, of course. But it's always their thinking. It's the mindset, and that's what gets you into retirement planning. Us just throwing numbers that may not mean that much right now. will not mean anything if they don't put any serious thought into it. Once a serious thought in, then you got a plan with only minor adjustments per year. And that's when you know they'll be comfortable in retirement according to, the information they gave us. Very key. And at the same time, if you started late, and you're open to the market, maybe we need a little more of a growth portfolio because you want a little of that higher return because you are starting a little later. If you have enough money, but just want to see your money growth, okay, maybe that balance or even balance conservative view. So it's a combination of, it's really, that's why there's such individual plans. It's not one plan fits all. Everybody's a little different.
Mhm.
Some people that made a lot of money have an incredible plan of spending a lot of money as well in retirement. Uh, and that's gonna, okay, you're gonna have to save a lot more if you want to spend over 100 grand a year in retirement. Some people may have a lot of money, but they don't spend that much. So again, we put in the numbers. Then we start talking about a little of the estate planning at the same time, and what are the goals there. So it really individually based conversations and regular conversations, not one and done. Even when they're into their 50s, it's never one and done. Let's keep that conversation open. Things change, life changes. There's always life events, whether it's grandkids, you suddenly become a widow. Unfortunately, that is happening. And I've seen that happen more often. That's when the planning needs to continue and adjustments need to be made. So that's why I think in retirement planning is very important, and it needs to continue even when you are retired to make those adjustments. Sorry, Jim, you're going to say something?
Yeah, no, I was going to say, like, I know you mentioned that people should try to have a vision of their retirement. I definitely have my vision: cigar, wearing a speedo on a beach. That's it.
That's not my.
Now,
it's not
people
my vision. Erase that vision.
try to fight it.
Yeah, right.
Well, so those are the top 15 questions and concerns for Canadians facing 2025. Ryan's the number 16, not seeing me in a Speedo. But that's for another episode. But yeah, I mean, we covered a lot of topics today. It's interesting because in many ways, these questions are probably the same year over year, but maybe in a different order, right? So I would suggest, again, like in looking at the theme of these questions and what people are concerned about, a lot of it is tracking what you're spending, what's coming in, right? Planning. So actually put a plan in place for yourself. And finally, it's also diversifying. Don't put all your eggs in the one basket and stop chasing the flavor of the month or the flavor of the year. So anything else you guys want to add? Final thoughts to our session today?
For me,
You're all good?
obviously a lot's going on for clients, and thank you, Denis, for joining us as part of this, because I think it's very important that we bring in many different voices when it comes to the dialogue of anything that's concerning Canadians as an overhaul. And again, as far as deep diving any of this stuff, it's important to really start not being overwhelmed with the things that go on, and holding and keep pushing it till next year, 2025. Let's make sure that people are having this dialogue with us, TVH Financial, the group as a whole, because we can really help people from start to finish when it comes to really understanding where their plan is, and helping often clarify what it is that they're kind of thinking, because again, we're pulling from all the experiences that we've had as individual advisors, and also the resources that we have to make sure that we can help you kind of formulate what retirement is, what your plan is leading up to retirement or goal setting. And when it comes to 2025, I think this can be a really successful year when it comes to our education towards each other and ourselves, and making sure that we're helping each other make sure that we're achieving our goals no matter what it is. So
yeah, and what I will share with people, what I believe we're really good at TVH, this is amongst all the departments, we really focus on what we can control and don't really focus on the things that we can't. Right? We can't control governments adding tariffs. We can't control how the markets are going to perform to some of the news. All we can control is how we structure your assets, how we structure your plan, make sure we protect you from some of the storms. And there will be storms. I know I've had people say, well, this is different. They're all different. But typically the response, the strategy is the same, right? So reach out to us and we will help you focus on what you can control and not so much on the things that you can't, right?
We're going to help you master your money mindset, Jim.
Hey, there you go. Look at you. Look at you. Wow. So this has been fun as always. Again, if you're looking for more information from us, you can do so at tvhgroup.ca, tvhfinancial.ca, tvhwealth.ca. We encourage you to just share and like this episode, both on the podcast and on the YouTube channel, and also look for us on social media. We're on all the social media apps as well. So guys, thanks again, Denis. Thanks again for joining us today. Ryan, as always, this has been lots of fun. And we will be, I guess, back next week. Same bat channel, same bat time. All right. Take care, everyone.